Okay, so this is part 2 of chapter 4, practice A. We're starting with number 6. So we're on the second page back and we're looking at a worksheet. So we're starting with that adjusted trial balance column, and it's telling us to complete the worksheet by extending the account balances into the appropriate financial statement columns and by entering the amount of net income for the reporting period. So what we're looking at is bringing over the balances that are in this adjusted trial balance into the appropriate columns, whether it's the income statement or the balance sheet, and then being able to balance those by calculating net income. So remember, income is revenue minus expenses. So we're going to look at our accounts and figure out which ones go on the income statement column and which ones go on the balance sheet column. Well, we know that on the income statement we find revenue and expenses. So let's look at those first. So we have our revenue accounts. The first one is plumbing fees earned. So all we're doing is bringing that balance over into the correct column. So if it has a credit balance, we're bringing it into the credit column. Then we're going to look for our expenses. We have 4 expenses here: depreciation, salaries, rent, and miscellaneous. We're going to bring their balances over. So in this column, there's no calculations we're doing. We're just literally bringing the balances over into the appropriate columns. So we have $13,000 in rent expense, and we have miscellaneous expenses of $8,700. If we look at our balances, we can see that there are no other revenue or expense accounts that we would bring over. So we can total them. If we bring down our credit side, there's only one, so there's 84,000. If we add up our other side, we are going to get 6,500 plus 38. We get 66,200, and that's the amount we're going to plug in here on this total. All right, but we see that there's a difference, right? So there's a difference in the amount of revenue and expenses. That difference is our net income. So if we take 84,000 minus 66,200, so 84,000 minus 66,200, we have 17,800. That's the amount of our net income. So we're going to put that in that net income line. If it's a net income, you're going to put it on the debit side of the income statement, so 17,800. If we then add to see what our totals are, we will see that we are in balance again. So the difference between those two columns was our net income. That same debit side is going to be brought over into the balance sheet side. So we're going to bring that 17,800 over on the credit side of the balance side sheet. So if it's net income, it goes on the debit side of the income statement, the credit side of the balance sheet. If it's a net loss, it's going to go on the credit side of the income statement and the debit side of the balance sheet. All right, so let's finish the columns. The last thing we need to do is bring over the balance sheet accounts or statement of owner's equity accounts. So it's basically our assets, our liabilities, our capital withdrawals. So let's bring those balances over. All right, cash had a $7,000 balance, so I'm going to bring that $7,000 over. Accounts receivable was $27,200. Trucks had a balance of $42,000. Accumulated depreciation, remember, it's an asset, but it's a contra asset, so it has a credit balance of $17,500. So we got to make sure we bring it over in the correct columns. So land is $32,000. And then we have accounts payable that has a credit balance of $15,000. We have salaries payable with a balance of $4,200. We're bringing over our unearned fees, which is a liability, $3,600. And our capital at $65,500. The last thing we have, which goes on the statement of owner's equity, so in this same column, is our withdrawals at $15,400 because we brought over everything else. So let's add up our columns now. So if we start with our debit column on the balance sheet, we had 7,000. And we get 123,600. We're going to put that here in our total, 123,600. And then we're going to add up our balance for our credit side. So we had 17,500 to start. and we get 105,800. That's what we're going to put on our credit side. 105,800. All right, we can see that our debits and credits do not equal, but we factor in that net income because remember, net income is going to increase that capital account. So that's why it goes on the right-hand side here. So if we bring our totals down, we have 123,600. If we add 105,800, plus our 17,800, we get 123,600. So we can see that we are then again in balance. 123,600. Our debits and our credits equal in all 6 columns, which is what we want to see. All right, so that's just bringing the balances over into those last 2 columns. In number 7, we're going to look at the adjusting entry column and be able to prepare journal entries from there. So let's bring that one up. All right, so number 7, it says use the following information from the adjustments column of a 10-column worksheet. So we're looking at each of the entries to then journalize. So remember, we can do our entries in the worksheet and then we journalize after. So all we have to do here is find the letters that correspond. So if we look at A, we had a debit for transaction A to insurance expense. So we're recording our debit to insurance expense for 900. Our credit, if we look on the right-hand side for A, was to prepaid insurance for 900. So that records transaction A. Then we do the same thing for B. So for B, we have a debit of $1,750 to office supplies expense. And then we are crediting on the right-hand side office supplies. So for that one, we're doing the adjusting entry to show how much office supplies did we use. In the first one, we showed how much insurance have we used from that prepaid insurance. Let's look at letter C. So letter C, we had a debit to depreciation expense for office equipment. And it was for a total of 2,200. And now our credit was to accumulated depreciation for 2,200. And that would be to record the depreciation for that period. All right, under 4D, we have a debit under interest receivable for $880. And we have a credit to interest revenue for $880. So this will be the adjusting entry where we're billing the client for services that we've completed that we had not yet billed. E, we are debiting office salaries expense for $560. And the credit that went along with that was salaries payable for $560. So in this case, we're recognizing that we owe the office salaries expense as of now, but it's not payday yet. So we're setting up a liability to pay them sometime in the future. So that's how we would record our adjusting entries from the worksheet. All right, we have one more that we're going to look at, and these are closing entries. So in number 8, it has us identifying from the 10-column worksheet. It gives us some information. It gives us the earned revenue and then expenses. So they first say to determine the amount that should be entered on the net income line of the worksheet. So if we knew that we had expenses of these 5 accounts and we had revenue, what we want to do is calculate how much revenue minus expenses we had. So we're going to start with 120,000 revenue minus the expenses of 46,300, 7,400, 16,000, 4,200, and 20,500. That's going to give us net income of $25,600. Now it's net income because it's positive. If it were a negative number, that would be a net loss. So we're going to enter that over here, net income of $25,600. So that's our first step. The next thing is to prepare the closing entries. So this is our first example with actually preparing closing entries. We have a lot more we're going to do in practice B, so you're going to get plenty of practice. All right, so for preparing the closing entries, we are closing revenue and expenses, right? So our first one, step one, is to close revenue. The revenue we had is rent earned. It has a credit balance. So to close it and make it zero, that means we need to debit that account. So we're going to debit rent earned for that $120,000. Now this is what's new. We are crediting a temporary account that we're putting the revenue and expenses into so that we can see the summary of income. So we're using that new account, income summary, that we're closing our revenue to. So we're crediting $120,000 into income summary. So we zeroed out what's in rent earned, and now we have a credit of $120 in income summary. The next step is to close the expenses. So expenses have a debit balance, so that means we have to credit them to make them zero. So the account we're going to debit is, again, we're trying to summarize income by taking revenue minus expenses. So we're going to debit that income summary account. We don't know for how much yet. We have to figure out our debits. So now we're going to credit each of those expenses they had up there. So they had salaries expense, which was $46,300. We had insurance expense of $7,400. We have office supplies expense of $16,000. Bike repair expense of $4,200. And depreciation expense for bikes of $20,500. So that's going to give us our balance in the account for income summary. So we're going to have a credit of $120,000. Now we're going to add up these amounts to figure out how much do we put in that income summary account. So let's add them up. We're going to have $46,300 plus $7,400. We have $94,400 as our total debit that we're going to put into that account. All right, so our last thing we need to do, we don't have any withdrawals, and it says the owner with H. Brown did not make any withdrawals. So our next step is to close income summary, and then we would be closing withdrawals. Since there is no withdrawals, this is the last one we're doing. So we have our income summary that we need to close. We can see that we put more into it in the credit side than we did the debit side. So it has a credit balance. So to close it out, we're going to debit it. So we're debiting income summary for the difference. The difference is our net income amount, which we already calculated up here, $25,600. So you can double check it by adding up or subtracting the credit minus the debit, but you should still get that amount of $25,600. Because it's net income and it's positive, we are increasing capital. So we're going to credit capital. So we're closing income summary to capital, and that's going to increase the balance that's in capital. All right, so that's our first example of closing entries, and that takes us through our practice A. We have several more examples that we're going to do with practice B that is get us through more practice with the closing entries. But at this point, you have completed practice A and can enter that into Connect.